Wait for this eye to come up. It's 12 seconds. No way. Maybe it's changed.
Yeah, it's been a delay for me when I do my live ones on Friday.
It's 22 seconds. Oh, here we go. Finally. All right. Hello, everybody, and welcome to Selfwealth Live, our technical analysis edition here with myself, Roger, from Selfwealth, and Jason from Motion Trader. Jason, how are you today?
Hey, Rog, I am good. Good to be back in the show with you for another discussion of charts and price action.
Yeah, it's going to be a big discussion as well as we have a look at the charts and see what they're doing. Not as much movement as it has been last few weeks, it looks like, but it's always good to have a bit of stability at the moment while we reassess things, right? So, welcome to everyone who's watching already, and welcome to all those that are going to be coming along as well for the ride today. I'll try not. Obviously, you're going to do all the talking, Jason. But as we already discussed pre-show, hopefully it doesn't. Hopefully, you don't lose your voice too bad now that you're not feeling the best and you've got a bit of a throat going on there, right? So,
So just to explain for the viewers, apologies if I'm a bit croaky today. After seeing off wave after wave of sick kids over the last 2 months, a bug has finally broken through the line in August, and just a little bit off. All good for today, but yeah. Just bit in the voice today, so apologise for that. But hopefully we've still got some good info for you.
Yeah, for sure. Well, I'm glad you still made it, Jason. That's the main thing, right? Otherwise, I don't know what I would do without you, Jason. So, all right. Welcome, Michael. Welcome, Jax. Thanks for sending in your already sending in some tickets for us to have a look at. Don't forget, as we do, we analyse the three main markets that we offer at Selfwealth, which is the AU, the US, and the Hong Kong market. That said, if you've got some other international market, more than happy to have a look at it. If you want to send that through to us. And then any general questions around technical analysis, that's one of the things that we sort of trying to specialize in this show, or anything to do with technical analysis. All right. So, and then tickers, we'll have a look at them from a technical analysis perspective as well. Any of those companies you want us to look at, and around the world, even not just Australia, we're more than happy to have a look at it and see what we can find out of it. All right, Jace, before we get going, let's have a look at the disclaimers, please.
Yeah, so quick disclaimer, everything today is general commentary only, no personal advice. And here's what we put up each week, just explaining all that. I'm also not part of Selfwealth. My business is Motion Trader. So you can see all my details in the top section, licensing, etc. And below there, we've got Selfwealth and its licensing. And again, just reaffirming general commentary only.
Fantastic. All right. Thanks, Jason. All right. So let's start off with, I feel like now that markets are starting to stabilize a little bit, the question is, with the ASX market, to me, are they stabilizing under a support line, or is it ready to break through to new highs again? Let's have a look at it. Eh?
Yeah. Okay. So let's jump over to a chart. We'll get the ASX 200 to have a look at. There we go.
I should say resistance line, maybe, not support. Right? Yeah, this is where it gets tricky, right?
So yeah, resist. Well, we want to look at support on the downside, and of course on the top side, the resistance. And well, last week was a pretty scary time for a lot of people. Really unpleasant sell-off. ASX 200 down about 8% in 3 days. So one of the quickest falls I think we've ever seen from an all-time high. So these swift reversals and sharp falls, I know they're emotionally challenging, but it's just one of those things when we invest in the stock market, these unpleasant episodes, they just come with the territory. So I think the big message last week was all about not panicking after we'd seen that swift decline. And one of the things we did last week when talking about not to panic was like looking through some examples, like what's happened in the past. And just recapping on that, there were a few examples just from the last decade that we had a look at, which I've got on the chart here. So these two, Let me see. Let me just go back a touch further. These are the ones I'm looking for. These two were like really good examples of like where we were last week, in that from an all-time high, a sharp reversal, and then a rebound to the moving averages. Again, sharp reversal, rebound to the moving averages. And that's often what we see. We often see these rebounds when we get these sharp declines. Now let's go back over to current day, and we can see that same sort of pattern repeating, in that we've had a sharp decline, now the rebound to the moving averages. So it's just price action we often see when price oscillates from one side of the average, well, not really oscillates, but goes from one side of the average to the other, and does so quickly, you get that rebound to the return to the moving averages. And I think that what we need to do now, it's like, we think like we've got this rebound to the averages here and now where we are, but where do things go now? How could this play out? And so let's go back in time again. I want to go back and look at these previous periods again, because they're good to sort of like understand and talk around. So now this could play out all sorts of ways, not just what I'm just showing now. What's happened in the past won't necessarily be what's going to happen this time around. Could be all sorts of things, but things to look for. One possibility is we get sort of this longer consolidation. So the initial fall, rebound to the averages, but that wasn't the end of it. There was still several months of sideways before the market resumed higher. That's entirely plausible for where we are now. Looking at this earlier example, this one's from 2013. That previous one, that was 2014. So this 2013 example, market started to regain momentum, headed off to new all-time highs. I think that's probably less likely in this scenario, but it is the way these things can play out. I think the more worrying setup for me would be if we saw something like we did in 2015, and that's where we get the swift reversal to the other side of the moving averages, but then the rebound is lackluster. It stalls beneath the averages, or pretty close to beneath the averages, and then starts to give away again. That's when you start getting that bearish structure, which can then lead to ongoing declines. We don't have that at the moment. It's just something to look out for. So coming back to the present day, I think all of those scenarios we just went through, I think they're all on the table. We've got this rebound. We just need to now monitor, what does the price action do from here? Does it continue up and set up a larger consolidation, or is it going to consolidate beneath these moving averages, in which case becomes vulnerable to then rolling over and testing lower levels? Last week, we were talking about de-risking a portfolio. So rather than panic selling after a 3-day decline, I spoke about maybe using a potential rally to start to clean out some of the weaker stocks in a portfolio. Selling stocks maybe had hit their exits and people hadn't sold yet. Possibly also taking some partial profits maybe on some big gains, and just de-risking. And I think the rally that we're getting at the moment, I think it's providing that opportunity. It's providing that opportunity just to take a bit of risk out of the portfolio, because we don't know how this is going to play out. Now, of course, upward momentum could return. ASX 200 could be at new all-time highs later in the year, and then some people would turn around and go, oh, well, look, I shouldn't have been de-risking anything. I should have just hung on, and maybe so. But this isn't, when I speak about these things, I'm not trying to be 100% right. For me, it's not about being 100% right or 100% wrong. It's about managing risk. So sometimes it's a case, I think, of tapping on the accelerator a bit. That's when we've got these nice upward trending phases. We want to take on a bit more risk when the market's in our favor. But when things become more uncertain and more volatile, risk appears to increase. It's sometimes also then about just tapping on the brakes. So I think with uncertainty running high, I'm happy to do that. Just tap on the brakes a little. I'm long stocks. I'm letting profits run, but I'm also holding a bit more cash. I'm being a bit slower to buy while we see how this structure plays out. What structure do we get in the next few weeks? If we start seeing more bullish setups in the coming weeks, well, great. We can just tap on the gas a bit. But at this stage, it's I think it's a case of just play a little bit cautiously and de-risk a little bit. Overall structure hasn't turned bearish, but these sharp declines, they do technical damage, and then they often take time to repair that damage. So I think at the minimum, we could be looking, I think there's a good chance we look at least several months of consolidation before we can entertain the possibility of new highs.
All right. Well, let's strap in for a lot of consolidation, which isn't very exciting at all, is it? But that's the market sometimes. One question I'll ask off the back of this myself is you, and a lot of viewers might not know this, but you have a time exit as well, right? So if we look at that period of consolidation before there was a bit of a breakout in the last few weeks, you're sort of maybe getting out of some of those stocks and de-risking, like you say. How long would you have held a stock before you think, all right, enough is enough, I might just get out of this one and look for new opportunities?
I give a stock 60 trading days. So if a stock is below my entry point after 60 trading days, I'll typically sell it. Sometimes I might give it a little bit longer if it looks like it's starting to regain momentum and pushing higher. But generally, that's the time window for me, 60 trading days. So it's about 3 months. Not a magic number. Someone could use 30 days or 80 days, but it's just saying it's. I think a time exit can work quite well when we've got limited capital. If you're in a stock which just isn't doing much with that capital, and there are other opportunities, or there's extra risk and you want to de-risk, it's just an opportunity to either take capital out, let it sit in cash for a while, or if there are opportunities, take it out of something which is not doing very much after you've given it time to like, it's had a breakout, it looked good, but it just didn't go on with it. Sometimes it often pays to take the money out of that, and there could be a new opportunity. Put it into the new breakout and see whether that runs. So it's just being a little bit more agile with capital when we're bullish, and when we're cautious, it's just a way of being able to take some money out of the market without like going out and selling all your best stocks and just getting out altogether, but just saying, look, I just want to pull back a bit, so I'll sell a few stocks which I've been holding. They haven't been doing much. Happy to go into cash for those and just wait for the new opportunities when they present later on. It's just a risk management play.
Yeah, and I've got a few of these in my portfolio, right? And the other question is, would you? I mean, depending on the chart, like you said, like hasn't gone any further after the breakout. It's just stuck there, but it's still in a little bit of profit. Would you cut that one, or would you only get the ones that are in a loss, a small loss?
I think, like, every time the market pulls back, if we assume the worst and we just start selling everything, I think we're going to get caught out more often than not, because the market does have these periodic pullbacks of 10%. I think 10% once every year or two, and every 3 or 4 years you get a 20% or more correction. Something around that. So every time you get if you're jumping at shadows all the time, you're always going to be getting out of the market, and then it's hard to get those big gains if you're always jumping out. So if a stock's in profit, unless there was a reason to be extremely cautious, and which I don't see at the moment, it's I'd be inclined to leave my profitable positions generally intact. And it'd be if I'm looking to de-risk, I'm just want to take out the ones which are not performing. If I've got there are a couple of stocks which I'm up considerably, like multi hundreds of percent. So they've become a larger weight within my portfolio. I've just used this rally just to trim those a touch, like sell a third. I like to let profits run, and mostly I do. But there are a occasions when a stock starts to become a larger portion of a portfolio and general risk might be increasing. So sometimes it pays to just take some off the table. We talked about that with Drone Shield, just by coincidence on the day Drone Shield peaked, saying like, if there's a really big gain, sometimes it pays just to scale out, not to go out and necessarily like try and pick the top, just scale out. It's because most of the time you won't get the top, and often the stock will continue running, and that's okay. But sometimes it will fall. So scaling out can be a useful tactic to use at times.
All right. I'll ask a relevant question to what we're talking about now. Are you looking at the weekly charts as additional reference points here, or?
Not really. No, I think that we've got enough information on the daily chart. Sometimes I'll jump to the weeklies, but at the moment, I think it's all around what's happening around the moving averages. For me, that's the important thing at the moment. It's like, I want to see what's the structure going to develop around these moving averages. It's like the bullish structures when we have price on the upside of rising averages. That's a bullish structure. I don't need to look at a weekly chart to see that. So what I'm looking at here is what's going to happen. We'll dip below the averages, and that can happen in a rising market. That's not necessarily a problem. But what happens now? Is it a case that we end up with price action over the next few weeks that looks like that, and these moving averages are starting to roll over the top of them, and you get moving averages which then looked like these are straight lines, of course, and the averages aren't, but start looking a bit like that with the price action below it. And then that sets up the potential for a breakdown. So I don't need to look at a weekly chart for this. This is the finer structure that I'm looking for. This isn't a prediction by any stretch either. It's just that would be a vulnerable setup. That's what I'm looking for. What will the price action look like as this develops over the next week or two? Sometimes the weeklies are useful, but at the moment it's this close in action around the moving averages, which I think is the most important part of this.
Yeah, no, it's great to see what you're looking for visually, even though it's never a prediction, right? It's great to see what you're sort of looking for prediction to be able to, know your thoughts and see what you're going to do next, right? So I hope that answers your question, Robert. All right, let's have a look at the US markets, please.
Okay, so going over to the S&P 500, and look, there is some vulnerability to this structure. The rebound off the lows has been, look, I'd call that at this stage a pretty lackluster rebound, especially when you compare it to the decline that it's rebounding from. So very quick to sell, slow to recover. So that's I think that does bring some vulnerability in. I think for me it suggests that maybe there's interest in selling this rally. That's why it's so slow. The buying lacks vigor, and there's selling which is coming in, which is slowing or even capping the rally. Now, I think an area to keep an eye on, it's around this 5,400 mark. So let me just do some drawing here. So we've got a gap. You can see this gap in the price action there. Technical areas where you can get support and resistance. We can just follow that along and just see how this works. So you've got the gap in there. We've got some lows from a few weeks back, and we've got another gap just as prices are breaking down. So I think this 5,400 is going to be it's a resistance point. So and it also coincides with the 50-day moving average. So if prices in the next day or so, if they can punch above there, punch above that resistance point, well, I think that would neutralize the current vulnerability. And this then in turn could turn into a larger sideways structure, or could even continue on to new highs. I do think at the least we're looking at more consolidation, but who knows? break this resistance point, I think it does take the near-term vulnerability away at the least. But if the market continues to stall beneath this resistance, then I think the risk is that we get more consolidation below the moving averages. So a little bit like I was drawing in with the ASX 200. Let me do that again. So if we end up getting this price action below the moving averages and the moving averages start to roll over, that's when it opens up that possibility for a break and then lower levels. So this is what we're watching for, and it's useful to have these reference points above the market. So yeah, below there and sideways is not really what I think we want to see. Currently though, look, this isn't a bearish structure at the moment. But like I was saying with the ASX 200, I think there is that vulnerability there, and I think it does warrant just scaling back some risk. I'm not talking about getting out of the market, just scaling back, just tapping on the brakes a little bit. And I think this rebound back to the moving averages, I think it does present that opportunity. Also interesting to have a look at the S&P 500 on an equal weight basis. Because what we had here, we had this really, really clear-cut breakout, had this trading range, lasted about 3 months, clear breakout. Breakout failed, got a false break. Market fell back down within the range, and this rebound, this rebound in the equal weight has even got less vigor to it than the S&P 500's rebound, and it's stalling just beneath the previous breakout point. So for me, this suggests there's supply coming into the market, which is in turn capping the rebound. As I was saying with the S&P 500, doesn't mean that this whole market needs to turn bearish, but it could very much mean that there's several months of sideways chop and consolidation. That could involve a retest of last week's low. If that were to break, it could involve a retest of the April low. You could do all that without having a big bearish structure. It could just be a big sideways consolidation before potentially higher levels towards the end of the year. That's jumping ahead of ourselves at the moment. Just saying, there's a lot of stuff in play at the moment, but there is vulnerability in the near term, the way this is. So for me, as I was saying, I think it's a case of trimming the sails. It's certainly not a case of panicking and jumping overboard. It's de-risk, not run away. I'm really just talking about scaling back risk. And I think this is where a trading plan really comes in. I think everyone should have a clear guide. They should have clear guidelines about when to hold a stock and when to sell a stock. And also, and this is important too, also what to look for when it comes time to buying a stock. So, not just going, oh, look, a stock's down today, so I'll try and get it at a bargain. I think that's a risky way to buy a stock. But having those clear guidelines of, what setups am I looking for to get back in? And the headlines, unfortunately, don't seem to help too much. I think a well thought out set of rules, that can be your map, that can be your guide that brings you through these difficult periods where things get volatile and I guess a bit scary too.
Yeah. What about, can we have a look at the NASDAQ just quickly? Because that was the one that was really pulling, these stock markets higher, weren't they, in the end? So, but it's very similar. Oh, if not, yeah, what does it look like?
Yeah, well, it's a weaker version of the S&P 500, and really it was the key driver of everything really was NVIDIA. It just got so stretched above these moving averages, it's pulled back. Now, it's like, where's this going to go from here? It's currently sandwiched between the 50-day and the 100-day moving averages. The moving averages are rolling over. It's like, for me, this is certainly not a buy moment. It could take time. This could well take time. And then that's having a big influence on the NASDAQ as well. So now we've got the NASDAQ, which is stalling below its 100-day moving average, as well, of course, as 50. Is it going to chop sideways while the moving averages turn lower and cross, in which case you get that vulnerable scenario. If we just go back a bit, you can see like how the market finished in 2021, where it peaked, fell below the moving averages. It did have a rebound towards the moving averages. Moving averages crossed, but it became a game of sell the rallies, not buy the dips. You can see the structure had changed. Prices now spending time below the averages, not being able to get back above it and falling away. And then that continued on for the rest of the year. That may not happen here, but this is what we're looking for when I say just watch how the price action develops over the next several weeks. What I think we don't want to see would be that shallow sideways consolidation, and then that opens the risk and opens the vulnerability for then the break to the downside. That hasn't happened yet. It's just what I'm looking for as a warning to maybe de-risk more. So at the moment, it's de-risk a little bit, just take a bit off the table in case that sort of pattern starts to play out. And if it's starting to play out, well, then maybe it's a case of taking a bit more off the table. But we've got to see. Just got to see. Just can't, as I say before, you can't be jumping every time you get a sell-off, because look, a lot of these sell-offs, they go straight back up. And even this larger one we had back in the middle of last year, it looked like it was breaking down, but then it reversed. So you can't be jumping at shadows all the time, or you can never stay in the market. So let's just see how this plays here.
All right, fantastic. Let's have a look at the Hong Kong market, please.
Not much. I don't think there's really much to do or say here. Rebounding off the lows, but look, we've got these moving averages crossing to the downside. It's not a strong structure. It's not a structure that says, look, I want to go and start getting involved here. It's I'm happy just to stand back and really not do anything here. Same when we look at the Chinese market. It's the structure's turned. It's we now got price spending time below declining moving averages. Looking where it is now, it's trading on its lows for the day. I think the path of least resistance is to the downside. I think it probably trades at lower levels maybe by this time next week. For me, there's no upside in trying to pick lows in these markets. Let a market stabilize, let it start to turn higher, and then you start letting the odds move back towards your favor. Trying to play them at the moment, it's I think it's a hiding for nothing.
All right, fantastic. Maybe if we've got time at the end, we might have a look at a few Hong Kong stocks just because some of the bigger ones, just to see if in the midst of this real bearish sort of structure in the Hong Kong and Chinese markets, is there a couple that you might find interesting. Yes, if anyone has any question around Hong Kong stocks, let us know. All right, let's have a look at some of the comments here or questions that we've got. First of all, Jennifer says, thank you for your signal. MAU was $1.15 when she got in, now $1.60. Do you want to have a look at it and see how's it look?
Yeah, it's a gold stock. And this is a lovely little breakout. Like look at this. Really, I love looking for those high probability setups, and they don't come along every day. So you don't expect every day you're going to get a setup which just stands out. But sometimes they'll come along, and when they do, it's like they're the ones to really have a good look at. So we had a situation where lengthy decline, stay away, nothing to see there. Got back above the moving averages, had the pullback to the averages, as we often see. Averages crossed. The structure was now positive. This is a stock to consider on pullbacks or even buying into strength. And then we got this nice sideways period where the price pulled back to the moving averages, traded along the moving averages for several months, and then started to break higher in July. So you got this classic consolidation and breakout structure. Pull back to just below the top of the range, back to the moving averages, and now has run again. So for me, a stock like this is very much a hold. I wouldn't be looking to de-risk my portfolio by exiting a stock like this. I'd be letting it run, giving a wide trailing stop, see where it goes. I'm probably less keen to buy it at the moment because it is stretched above these moving averages. So from a managing risk perspective, it's probably not an ideal entry point. But yeah, I think it's a great hold, and it's just a good example of a sort of setup we can use to make money from. Like, I want to buy stocks that are trading sideways along their moving averages after initial run and then breaking higher. Not try and pick lows in stocks as they're in decline. That's where, it's like we're saying with the Chinese market or the Hong Kong market at the moment. It's below declining moving averages. Step back, leave it alone. There are other things to look at. Look at stuff when they're on this side, when they're on the upside of the averages. That's when I think you put the odds in your favor. Doesn't mean you're going to make money all the time, but the odds are in your favor. And we all know how this plays out. You play a game when the odds are in your favor, and over time, if you manage your risk well, you should come out ahead.
Okay, fantastic. What about Jacques is asking for IRI? IRI.
So so this is a motion trader stock. We got a buy signal on this back in April, and then we got a really quick run up. It's come along. It's run a long way. It's now pulled back to those averages. It's for me, this would be a hold at this stage. I don't want to. I'm slow to buy a lot of stuff at the moment, just with that general volatility. So this isn't a dip I'd be interested in buying at the moment. If the market was in a strong uptrend, well, then maybe I consider buying a dip like we're seeing, but not with the current state of play in the market. So it'd be, for me, a stock like this would be a hold, not a buy. There is there's a little reversal pattern there. You can see there's a head and shoulders pattern. There's your left shoulder, there's the head, there's the right shoulder, and we've had the breakdown below there. I don't think they're terrific medium-term reversal patterns. It's just at the moment, at this point, it's just a sign of a market which had run a long way and it's come back. So this is one I'd be holding, using my trailing stop.
Yeah. All right. And what about MSV?
This was one I had in my portfolio, and I sold it. It was one of the ones I used to de-risk. Now, don't take that to think, oh, look, Jason sold it, I should sell it. It was just one of the, for me, because my entry point, I can't remember exactly, but it was somewhere, like, say, for instance, it was at this point in May. I'm not exactly sure that's where it was. It could have been, it was somewhere around here, and the stock was a little bit in the red. So this is how I use my time exit. So I said, look, I bought it as it was breaking higher. It hasn't gone on with it. I want to just shut some risk down. So this one's a little bit below my entry point. I'll use that. I've given it enough time. I'm out. But this could still just be a sideways range that it's in at the moment, which could resolve to the upside. So yeah, at the moment it's a range-bound stock. It's got support coming in at around 39. For me, it was okay. As I was saying, I'd given it enough time. I wanted to shut down some risks, so I let it go. But it's also nothing wrong with holding a stock like this as well. If the market wasn't as it is at the moment, I'd be more inclined just to hold it. Another strategy for a stock like this would be if it breaks below these previous lows, which is looks like 39, and then it is below the moving averages, so there is a risk of a structure change. Like if somebody wanted to sell before a wider trailing stop to de-risk, well, then maybe that could be around that 38 sort of mark, like just breaking below the lows, giving you a little bit of extra space, because sometimes stocks will just tick below a previous low and then push back up because there's no follow-through selling. So give it a little bit of extra room. But yeah, look, it's one which could be exited around 38. But it's not a bearish structure at the moment. If anything, it looks like a stock which is, which could which does have the potential still to go higher. But I'm happy to come back and look at it if we start seeing it come out of this. Maybe this is another basing platform, another type of platform that's on it. Start breaking to the top side, then maybe I can look at it again. But at the moment, I used it as one of my areas of de-risking.
Okay, what's the difference between the top of that range and the bottom of the range is what, 10 cents basically.
Thereabouts.
All right, let's have a look at URNM ETF, please.
URNM?
Yep, uranium, I'm assuming.
Yeah, so we'll look at the there's a local version which doesn't have as much data and isn't as active. We'll look at the US version, and this is one I've got a stake in as well. So I got my stake back. It was here. I think it was mid-December 2020. Saw off this lengthy consolidation period. So this is a sort of not so much a trading position for me, more it was what I've been hoping would be a longer term hold I don't really do longer term holds in individual stocks, but an ETF is a bit different because it's more of a mini fund, and so I've still got it. I've sold all something I've been talking about in my weekly strategy videos each Friday. I've been talking about the uranium price. Maybe just jump over to the uranium price as well. So been talking in recent weeks about how the uranium price was becoming vulnerable. The structure had changed. We'd gone from above the moving averages to below, consolidating below the moving averages. We've spoken a lot about that sort of price action already today. That set up a vulnerability which has been playing out to the downside, so it remains vulnerable. So I've exited all of my individual uranium stocks. My last uranium holding is in this ETF. I was looking at it this morning thinking, where do I rule off on this? How much longer do I give this to run? I haven't quite worked that out yet because it's longer term. It doesn't quite fit my usual pattern. Certainly not a stock I'd be buying at the moment. Wouldn't be buying anything in the uranium space. This isn't a dip I'm interested in buying. I want to buy something which looks like maybe it's found a base and is starting to rally again, not buy something as it's falling. This was an ugly period to see off in 2022, 21 to 22 in that period. It's entirely feasible this turns out to be another one like that. So this is where someone's got to also work out, what am I doing? Am I doing something? Am I basing this investment off a view I want to hold for the next 5 to 10 years? Or is this more of a strategic trade based on momentum, which I'm happy to let run for maybe 1 to 3 years if the trend continues with manageable pullbacks? But to hold something for 5 to 10 years, well, then you go into the space where you're going to get most likely much larger pullbacks. So it becomes a different thing. It's not so much a trailing stop. I don't think a trailing stop's ever going to work for a 10-year period, unless you're looking at a weekly chart, which I'm not doing. So at the moment, I'm still in it. But it's at that point where the moving averages are very much crossed. It's stretched to the downside. Some sort of rebound back to the averages would be entirely possible. If that were to happen, I could even consider selling into the next rally. But I want to watch the price action. I'm not sure. It's when we look at the uranium price and we put it on a weekly chart. So I do look at the weeklies, just depending on what the situation is. Given the magnitude of the rally we had through 23 into 24. The pullback we're seeing at the moment, it's entirely, I think it's entirely in scale to the rally that we'd previously seen. So this could be part of a consolidation or correction which goes on for 2 or 3 years, where it's just a big, messy range, which could even come back a bit further. But then you look at this in 5 years and it's up at new highs. It looks different to this peak we had back in 2007, which was very much a parabolic acceleration and then an equally sharp decline. this currently doesn't have that structure. It's taking longer to come back down. So it looks more corrective. But look, I don't know. We're still going to manage risk around it. But these are things everyone's got to consider. Are they what's the time frame of what they're doing, and also not letting a position which they think they're holding for. It's a mistake a lot of people make. They buy something, they think, look, I want to hold it for a month, and it doesn't go their way, and they end up holding it for 10 years. So you don't want to let your time frame drift. Work out, what am I? Am I going for short term, medium term, long term, and try not to let the focus drift because you're losing money. If you're medium term, you're just in there for 1 to 2 year uptrend. It could be it's probably getting to the point where you've got to really consider, should I be holding on anymore?
Yeah, and can we just have a quick look at the Australian version of it? Is it a chart that doesn't look very good at all? Or? Yeah,
it's not that it doesn't look very. It looks similar. It's just less data because most of the movement happens in that US time zone. So that's why I do that. But what you can do, you can do this with TradingView. So let's go back to the US one, and we can change the currency, change it from US dollars, and let's just put it into AUD, and just it looks similar. Like if I just put this chart up, you wouldn't know that I'd changed it, but it has changed to fit the currency. So you can do it with some of these US stocks which has an Aussie listing, which maybe doesn't trade as much, or if you want to see what the S&P 500 looks like in Aussie dollars because you bought the Aussie S&P 500 ETF, but you're looking at it in US dollars, what's it look like in Aussie dollars? That's how you can do it. You can just change the currency over.
All right, great. All right, we've got a lot of tickers to go through, so let's have a look at CDA, please.
CBA.
CDA, DA. CBA is always a good one.
Yeah, it's
we'll never go away.
Looking at Coden, uptrend still in place. Pull back to the rising moving averages, but yeah, it's an uptrend. There's no sign of this turning bearish at this stage. Doesn't mean that it's going to continue up over the next few weeks. Maybe this is the start of a consolidation. As you can see, it has consolidations. Look at this consolidation through 23. It went on for about a year, just tracking sideways. So these things will happen, but the trend's up. So with a wide trailing stop, my aim would be to stay with it, try and see off any potential pause.
Okay, GMD, please. GMD, sorry if I'm saying it.
GMD. So is that it, Rog? GMD?
Yeah, Genesis Minerals Limited looks like.
Looks good. Trends up, rebounding off the moving averages now. It's doing its own thing. It's not really correlating to what the market's doing. If I had this one, I'd continue holding it, let it run, wide trailing stop below the 100-day moving averages, see where it goes. It's even possible someone might want to buy a stock like this, which has rallied, which has pulled back to the averages and rallying. Stop loss maybe just below the previous low, but as I said, I'm happy to be cautious on the buy side at the moment. But a stock like this, happy to let it run. Again, look, you can see that the consolidation we spoke about earlier with Magnetic, where you got a stock which is rallying above the averages. You get that sideways compression, you get the breakout. So it's rallied, it's come back to the breakout. Looks like it's starting to try and rally again. Sometimes you get these setups which look really good, but because the overall structure of the market is volatile to vulnerable, they don't perform as well as they could when you got a generally positive market. But yeah, look, I think overall it does look good, so I'd be happy to hold it.
All right. What about LOV?
Yeah, it's so I've got this sideways range. what we've just been talking about. Had a breakout in mid-July. Breakout didn't stick though. It's now come back within the range. Just trying to rally out of it again. It's like if I had this stock, I've got no problem with continuing to hold it, but I'd be hesitant to buy it at this point. I'm hesitant to buy most things at this point unless something really, really stands out. And this doesn't stand out as a buy, but as a stock which has been in an upward trend for some time, if I was in at a good level, I'd be happy to hold it, wide trailing stop, see if it can continue to push out of this range.
Mm-hmm. All right, looks like you got some pretty good stocks in your portfolio there, Kirby, if you've got them, obviously. TNE.
Uptrend, nice clear-cut uptrend, doing well. Like, look, making a new, is that an all-time high? I think that would be an all-time high.
The question is it too expensive, by the way, from Roger?
Well, I wouldn't, I'm not inclined to buy it here because it is stretched above the moving averages. I prefer to buy a stock when, like, it was like, this was an opportunity. You can see this range. This is drawn in at a previous time. Went sideways for about a year, got a breakout, pulled back to the top of the range, started the rally. This was sort of the time to be probably looking to buy it. Now it's run, accelerated from the moving averages. If I had it, I don't know where it's going, so I'm happy just to go along for the ride, see where it goes. I don't want to preempt the top. If I was worried, I could, and the position was becoming too large within my portfolio, or I wanted to de-risk, maybe I could scale out of it a little bit if the profit had become to such a point where I was getting uncomfortable with it. But I wouldn't sell a stock just because it's hitting new highs and because it's done well. It's the reason I make money out of a stock which is hitting new highs and I've been in for some time is because I've resisted the urge to sell and I've stayed on board. So I want to continue doing what has worked for me, what has made me the money, and that has been staying in winning positions, not trying to pick the tops and getting overly nervous that it's had a big run, it's due for a fall, or it's getting expensive. Fundamentally, I don't know. Look at Drone Shield. It currently doesn't make any money, and it went up. How far to go up? 500% or something like that. So, of course, it's come back down, but you still could have made a lot of money buying the breakout, letting the profit run, using a wide trailing stop, or even scaling out after it had run a long way. So I don't want to preempt where things are going to end. Could end nearby, or it could continue a lot higher. So I make money by letting profits run, not by trying to pick tops. Sometimes occasionally scaling out if I'm getting uncomfortable. But yeah, let the trend do as much as it possibly can.
All right, now let's have a look at ZIP, ZIP.
Trend is still up. Yep, it's had a bit of a pullback to the moving averages, but trend is still up. Maybe this is the start of a longer consolidation. Maybe it's the start of a topping phase and it starts coming down, but we don't have that information yet. So I think we've got to work on the basis that what had been happening previously was we had a stock which was rising above rising moving averages. So remains, for me, this would remain a hold. Again, I'm not too keen to buy at the moment, but it's a hold, wide trailing stop. There's nothing here saying that the trend has finished or that the structure has changed.
Okay. All right. BHP.
So BHP is an interesting one. It has been traveling sideways for over a year now, really. So let's just compress it a bit. You can see this big range bound period, and what we've had in the last couple of weeks is, and I've got this support drawn in on the chart. which also marks the lower end of that big range it's been in. It's broken below this support, so it's in a vulnerable position. Similar pattern we saw in uranium earlier, where the price had moved from above the averages to below, had been consolidating beneath declining moving averages. And this is what we're talking about with the ASX 200, with the S&P 500. This is sort of price action that I'd rather not see, but we've got to see what develops. It's this is where markets become vulnerable, when they're consolidating below the moving averages. It's now broken lower, broken below support. It's not a stock that I want to buy, and depending on where I bought it, it'd be a stock which I'd probably sell. But I want to just qualify that, like the people who have been holding BHP since way back when. So, as I was saying earlier with uranium, what's your time frame? If you've been in it for years and you get the dividends and you've just stuck with it and you've done well, I don't know that you'd necessarily be selling on a break of a relatively short-term support. It's a mismatch of timeframes and objectives. But had you bought in recent months, you bought it above support, see where the support holds. Support hasn't held. Well, from that perspective, it'd probably be a sell. If you bought it back in November 22 as it looked to be breaking higher, and you'd stuck with it over the last year, it would probably stack up for me as a sell. So it all depends what your perspective is, what you're trying to do. If we were to see this reverse in the next couple of months and find itself back above this previous support, which is now resistance, back above the moving averages, then potentially we've got a false break, which then sets up a potentially profitable buying situation. So different ways this can play out, but at the moment for me, it's an avoid. If you don't have it, if you do have it, it's working at your time frame, when you got in, why you got in, what you're looking for, but being aware that you're in a stock which at this point is in a structurally weak position, in that it's trending below declining moving averages.
Yeah, and broken that long time support line or resistance there. So, all right, let's have a look at AZJ.
Yes, well, what's happened here? Interesting in that, like, look at the structure. So let's just take that section out. Let's say this is last week and we're talking about it. What do you think I'm going to say about this? I'm going to say we've got a stock which is consolidating below declining moving averages, which makes it vulnerable. Now, making a stock being vulnerable doesn't mean that it's going to fall. Stocks can come from a vulnerable position and then start to recover, get back above their averages and start to rally again, in which case that creates the buying setups. But when you've got a stock which is trading below the averages, it's vulnerable. And in this case, that vulnerability has very much played out. This is why I don't like to try and buy lows when stocks are below moving averages. Sometimes, it works out, but when it doesn't work out, it can be a mess. Not a stock I'd want to own. If I had been buying the breakouts earlier on, it would have been, for me, I would have been exiting before now. So it's not a stock I'd be in. If I am in it now, what do I do? I think let me just compress this a bit. Let's just jump to a weekly for a moment. Yeah, these things. This is where these things can get hard, because you can look at something like this and go, well, look, is this like actually going to be a big support zone where it's had a sell off to some announcement out of the company, but it's not going to just continue falling away. It is going to base somewhere around here. Is that like that's like one possibility? Coming back to the daily, having seen that, so looking at where it is now, so it's already it's already spiked lower and it's come back. So taking that on board, if I had this stock now, if I was stuck with this stock now, the way I think I'd play this would be I'd see what happens with this rally. Is it a case that it's sold off? It's any stops which were below this previous low. Maybe they've now been triggered. Maybe that's a spike low, and it's come back strongly. Can it start to make its way higher? I'd probably now have today's low as my exit point. If it breaks below today's low, I'd say, look, had to surrender on this one. I'm out. Got to protect capital, cut my losses, move on. But if it rallies back, look what the rally, see what the rally looks like. If it's has some strength to it, maybe it's could stick with it, or maybe it could be like sell on a rebound towards the moving averages and just move on to other things. It's not a case that we have to hold every single stock forevermore or until we get back to even. Sometimes it's best just to say, look, okay, this one hasn't worked. I'm now trying to salvage the position. I'm trying to salvage as much capital as I can without just hanging in there for forevermore. And then I just accept my losses, get the best result I can, and move on. So I think this is going to be one of those ones probably to be moving on from. It's just strategically, when's the best time to do it? Is it going to be into a rebound, or will it break down again and make a new low, in which case it'd be probably time to rule off.
All right. I hope that if you own this, Fred, hoping for a spring, I'm sure we all do hope. But as you're aware, Fred, I'm sure you know that hope is not a strategy, and Jason's provided you some good insight on what you can do, how you can play around this. And Awanda, by the way, I'll save Jason a bit of voice here, give him a bit of a breather. Awanda is it's a FX trading CFD platform, if you're asking what that is. And you might see that sometimes when Jason's scrolling through tickers, and it has the data feed from where the brokers, where it's coming from, right? Where the data is coming from, right? So it comes from brokers if it's an FX thing. So yeah, that's what you might be seeing there, Awanda. All right, let's have a look at Life 360.
Yeah, it's still going well. It's this has been in the Motion Trader portfolio for a while. Look, all I can really say is trends up. There's no sign of trouble at this stage. I'd be inclined to let profits run, wide trailing stop. I've already talked about not being too keen on buying much at all at the moment, but yeah, this is one I'd be happily holding until the price structure will eventually change. And but at this point, there's no signs of it. I think it's a case of staying with the trend.
All right, CSL.
Well, this has been really hasn't been much fun for a while, has it? It's going back to, you got the pre-COVID peak, and it's really not done much since. How would we draw this range up? It's a bit of a funny range because it's got a downward slope to it, but you can't really line up the these don't line up, I don't think, anyway. Just quickly playing around with it, like, you can fudge a line through there, but I don't think it's really, it gives some sort of idea as to where a range is, but I don't think that's a tremendously meaningful line. But look, broadly, it's been in this large range for a long time. It's not a stock I'm particularly interested in. Look, maybe the play is just to do resistance. Say there's the resistance band. That's probably the way to look at it. So we've got overhead resistance. There was a play maybe in buying the moving it. It got above the averages. So there's a play in buying the rebound to see where it went. It could still resolve to the upside, but at this point, it's top of the range stuff. It's pulling back from the top of the range. I'd be inclined to, if I had it from lower levels, there's nothing wrong with. Well, if I had this from lower levels, I'd probably be inclined to keep it. But if I really wanted to de-risk a portfolio, I'd also look at this overhead resistance and saying, look, I'm not up much on this one. It's got resistance, market's volatile. Maybe this is one which I could just use to de-risk the portfolio. I just move into cash. And then if I come back in 6 months and it breaks out of this range, well, then I can reestablish the position. Of course, you're reestablishing at a higher level. That's the opportunity cost of de-risking, that you do have to buy back at a higher level potentially. But then, if the market were to turn lower and the price comes down, well, then you're happy you've de-risked it. So you're not about, as I say, not about being 100% right or 100% wrong. Sometimes you're just trying to move the pieces around within the portfolio to keep your risk in check, just working out like how I want to keep it in check. Unlike some of those other stocks we looked at, there's not a dominant trend driving this one.
Mm-hmm. All right. What about FMG? A lot of mineral stocks.
Yeah. So this is a stand clear and avoid. It was a motion trader stock a while back, but hit a trailing stop. I can't remember exactly when. You can see how I've got. I initially drew this in as a resistance point. I think I might have been looking at this stock, a while ago, last year. Broke above the resistance. Initially started getting a nice trend, but didn't really follow through into anything. It's come back. Now that resistance now becomes support. It's broken below there. You can see it had a rebound. Must have been supply coming back in around that resistance point. Turned down again. I wouldn't have this stock because it's been breaking down for a while. So I'd be out of it, and I wouldn't be looking at buying it. We don't know. We don't know when this is going to stabilize and from what level. So for me, it's a case of protecting capital when things aren't working, and if they start working later on, well, great, come back and have another look at it. Again, as I said with BHP, I know some people have held some of these big mineral stocks for ages and ages. So if someone's been holding for years and years, make sure you understand your time frame, because when I'm talking, I'm really working the assumption that people have got medium-term positions, not longer-term core holdings. It's a different situation.
Yeah, it's a good distinction there, obviously, just to be aware of. As you pull the chart out, obviously if you bought it at a lot cheaper level, and you've got to reassess at that point, right? So WDS, is that Woodside? Is another miner.
Yeah.
It's probably down on the doldrums there.
It's the same situation as Woodside. It's not a strong structure. You've got the declining price below the declining moving averages. Where it ends, nobody knows. This could be the low, but the odds favour that the low is somewhere in the future at lower levels. We just don't know. So for me, it's a case of it's a stock to. I've actually got some of this. It's like I got a small holding I held BHP a couple of years ago, so I got a residual position, which I don't even look at. It's like, it's not worth very much. So where I say it's not a stock I'd be holding, I actually am holding it. But if I was holding it in size, I wouldn't be holding it. I'd be paying much more attention to it than like a few $1,000 position. It's neither here nor there. But from a mainstream portfolio perspective, for me, it's not a stock I'd be holding whilst it's doing where it currently is, and it's not a buy either. I don't want to try and pick the low. I don't know where the low is going to be. I'll come back. the low could be, even if it makes a low here, could then go sideways for months. So who knows? I'll come back and look at it when the structure turns more favourable.
All right. Thanks for that, Jason. I'm going to ask, just pause and ask, are you still okay? We're in overtime now, obviously. Are you all right to go another 5 minutes? Because there's quite a few, so we'll try and get through as many. Thanks for all of them, but we'll try and get through as many as we can. If not, we'll carry forward some for next week as well. All right, let's go with MAD.
MAD.
Yeah.
Yeah, well, the structure's becoming vulnerable. Also important to note, though, when you get a stock which is in a range, which this one currently is, it is within a range, and within a range, a stock's going to oscillate either side of the moving averages. So it was vulnerable back in April, but remember what I said earlier. Being vulnerable doesn't necessarily mean a stock's going to break down. It just means be careful, because it's in a weakened position and it's susceptible to a breakdown. Doesn't mean it will happen. So in this situation, it didn't break down. It switched back to the rally back towards the top of the range, went to the other side of the averages. Now we find ourselves back in this position below the averages. So again, becomes vulnerable, but it's still within a range. Hasn't broken down from the range yet, and it may not. Maybe it breaks to the top side of the range. So this is, for me, this is one of those ones well, it depends where you got in. If someone was in from lower levels, fine. I'm happy to sit through a lengthy trading range. But if I got in this stock more recently, say earlier this year, as it looked like it was breaking up, this is one of those situations where I'd use my time exit and I'd sell. Now, there are plenty of stocks I sell using a time exit, which ultimately do stabilize and turn higher. And someone would go, oh, you shouldn't have sold it. But I've moved the money onto something else, and something else might have done really well. So it's like, that's the way a time exit works. Doesn't mean a stock's not going to perform. It means, well, it's had enough time, I'm going to go somewhere else. So for me, this one probably would have had enough time. Saying that, nothing wrong with continuing to hold a stock. The stop loss for this one, for me now, would probably be just below the range, below the October 23 low somewhere. If it starts breaking below the low from a couple of weeks ago, breaking below the low from October 23, got the vulnerable structure which we've spoken about, it starts becoming, well, okay, I've just got to protect capital and rule off.
Okay. What about ALC?
Interesting structure. Big declines. Like, it's we've gone from below the averages to above averages have crossed. So there's potential with this. Now, is it a case that maybe we get a bit of sideways while the moving averages catch up? In which case it could then be a buy the breakout. That would be the way I'd probably prefer to play it. I'd like to see whether we get, some price action like so, and then buy the breakout. That's probably how I'd play it in this environment. And that may not happen. So we mightn't get the sideways and we mightn't get the breakout. So then I don't need to buy it. So that mightn't play out. Instead, it might just start falling away, in which case I never get involved. That's fine. But I'm looking for a tradable setup, and that would be a tradable setup for me with what I just drew. If I was already in this stock for whatever reason, I'd stay in it and see whether this potential emerging trend continues to emerge. Stop loss could be below the 100-day moving average, so risk is manageable. Even though it is a 7.2 cent stock, it's still, so the percentages come bigger when you start getting down into the low cents. Risk is manageable. So it's look, it's a stock of interest. That's how I'd be playing it. If I was in it, holding it. If I wasn't in it, see whether the structure gives a setup which we can trade off.
All right. I might just finish off with a general question as we sort of run into overtime, real deep overtime now. Just a question here around: Keith, do we just stay out of the US market until after the elections?
Not necessarily. It's for me, it's all based on the price action. If the price action warrants a trade in the US markets, I'm happy to go into them. If the US markets become difficult, it's probably going to flow on to the ASX too. So then it's saying, well, should we just be out of stocks until after the US elections? And like we'll know the best action in hindsight, but we can't really operate with hindsight, can we? So I think the best we can do is look at the price structures as they are, as they develop, and act according to our trading rate, our trading plan. So no matter what the market does, whether it goes up, down, or sideways, if you've got a good trading plan, it's going to tell you what to do in each of those situations. Doesn't mean you'll make money, doesn't mean you won't lose money, but there's a plan. And that's how we get through difficult spots. We be consistent, follow good strategy, and keep our risk in check. So we don't get emotionally. We don't emotionally blow up because there's just too much on the line. But I don't think we necessarily need to get out of markets completely. Watch the price action and be guided. We spoke all about that earlier on. 10% pullbacks, jumping at shadows. Sometimes the shadows become nighttime, but you don't know till later on. At this point, it's a case, as I keep coming back to, we're managing risk, not foreseeing the future.
Yeah. All right. Like all good shows, they do have to come to an end. We will do a to be continued. Actually, Robert, you had some good points and questions in there, which I think actually Jason answered a lot throughout our show anyway, to be honest. So, but we might retouch on some of those points next week, as well as your tickers. If we didn't get to them, my apologies, or our apologies. It's tough to try and keep everything in within 1 hour when we've got so many good suggestions here to have a look at. All right. But we do appreciate you continue coming in each week and give us some questions and insights into your thoughts as well, which is great. Jace, as always, I hope you get better. Right? I hope you're feeling better for next week.
Yeah, I'm sure I'll be back to 100% for next week. Thanks everyone for coming with so many stocks and questions. I'd love to keep going with it all, but it's like, maybe I've got to speak a little bit less about some of them, because some of them, they do tend to lead to other points, and it's hopefully the points these things lead to are interesting and help build your own knowledge and information bank about how to look at price structure and think about risk and opportunity.
And I think that's the point, right? If we just said yes or no, we'd never learn, right? But I like how you always try and find the silver lining in some of them, which is it's a good trait of yours, Jace. I think I'd be a little bit more blunt than you, but that's all good. That's your thing, which is great to have. So thanks everyone for coming once again, much appreciated. Don't forget to like and subscribe or comment. Visit us, say hello. I'm Roger at Selfwealth. You can always send an email through to support, and I'll get your email obviously as well. It'll be forwarded to me, or you can go to Jason at motiontrader.com.au as well and say hello to him. All right. Thanks everyone. Have a great week ahead and stay safe.